Welcome to the Money Pig Podcast, presented by Goodwin Investment Advisory, where our mission is to lead you to financial pig, peace, independence, and generosity. I'm your host, Tim Goodwin. Welcome back to the Money Pig Podcast. We are super excited again to have Justin Pitcock with us. You're wearing the same shirt as last time,
it's
Justin.
It's good to be back.
Man, yeah, that's your podcast shirt. Way to go.
Right.
So, and I would be remiss if that we weren't also sharing that we have another guest in the room. We have the notorious PIG right here. Right. He's our mascot, looking kind of like a rapper over here for sure.
What does that stand for?
The notorious PIG.
Yeah.
Peace, independence, and generosity.
Nice.
Awesome. So we are here to do part two of our top 10 pro tax planning tips. So we're going to go through the second half today. Before we do, Justin, share with the audience something they may not know about you.
Well, gosh, I don't know about me, but I was going to share something new for GIA.
Let's go.
So, we manage obviously portfolios for clients, and we're going to be adding a new strategy coming up.
Look at that!
We're working on
fresh out of research and development, folks.
That's right. So we're working on a slightly more aggressive strategy for those that may want their Roth IRA to be on Octane, or maybe somebody that's a little younger that's still got a ways to go and they're wanting to just totally maximize growth. So
we realize we've got clients that have been asking for that, and that's just one thing that's very important for us about our business, our model, the services, what we offer is we're really trying to listen to our clients and what they want, what they need.
And it's just, the purpose is just to be kind of that one level more aggressive than what the strategies that we currently have. So,
Yeah. We'll be excited to have more information to share about that shortly. So, Justin, I don't know if you are aware of this, but the oldest computer was owned by Adam and Eve. Mm-hmm. Now,
tell me about it.
It was obviously an Apple, had very limited memory, just one byte and everything crashed. Oh gosh.
That's the way I feel right now, because
tell us about how you feel.
I've been using a PC forever, and so I just got
the suffering that you've gone through.
Just got a new computer. It's a MacBook, and it's working out. And it took me a long time to figure out how to right click. Sitting there in a meeting,
this is so tough.
Right clicking, it's not working, but figured out it's a two finger click. All right.
Gosh, got it. Life changing there.
It's good.
Yeah, you're getting retrained, and we just they've got the newest one in the office now, man.
That's right. Everybody's envious.
We are. So that's great. Hopefully you have a whole lot less computer crashes happening moving forward. So today, just real quick, the reason why we have a podcast episode about tax planning tips is because it really, really matters to folks. If you are listening to this in the first one, you might want to go back an episode and get to those first 5. But we did share that it's super duper important. Usually when you're in this accumulation phase, it's about the money you can make and save. But in retirement, it just really shifts to a strong focus on how to minimize the amount of taxes you're paying. There's a lot of strategies out there. And there's a little bit of this voice of reason I realized from our first episode that's saying like, hey, you're going to be concerned about this in the future. If there are things that you can do now, that your future self would tell you.
That's right.
That's a little bit about what these 2 episodes are about. There are some things that you can do intentionally while you're accumulating to be in a better tax position in the future, because that's really, really going to matter. And I love that quote that you said on the last episode was not just about what you have.
It's how much you keep after you have to pay the tax on it.
Exactly. And it's a complex, ever-changing landscape. And so I think it's just reassuring. I think it's a whole lot less. I think taxes bring a lot of anxiety with the finances, but to have somebody you trust that's experienced in this area is a big deal. We're all certified financial planners here. And that means that we have had lots of training and even testing on tax strategies. So we're not CPAs. We don't do tax returns for our clients, but we try to do a lot of tax planning and strategy. So to get kicked off, this is pro tip number 6. Tell us about tax loss harvesting.
All right. Well, again, it's one of those things that we don't just do without knowing your situation. But tax loss harvesting is where you have one investment that has lost value and we sell it and simultaneously replace that with a new investment. And so when we have a portfolio, obviously this is in a taxable brokerage account, we may have a dozen or so different positions in the account, maybe more. Well, when one position's down, each position has its own purpose. We can sell it and immediately replace it with a new similar position that serves that same purpose in the portfolio. But in doing that, we realized a paper loss. You're still invested when that category of when that asset class returns and it rebounds, you're going to get the upside, just like the old investment, but we've harvested a tax loss. And so the tax loss can offset other gains. Maybe you sold some investments at a gain. If you had a $10,000 loss and a $10,000 gain, they net out and you would not owe any tax at all. It just nets out to zero. But let's say that you, for the year, had more losses than gains, and you can use some of that to offset some of your ordinary income. So up to $3,000 a year. It's not much. That number's not indexed for inflation either.
That's crazy. It's been $3,000 right? Forever. Come on, guys. Yeah. Seriously.
So, but to have be able to offset a little bit of your ordinary income, maybe you're in one of the upper tax brackets, getting taxed at 32%. Okay, well, that's a little tax savings there. But the big benefit for those where the strategy works is maybe they're going to sell a business. Maybe they're a business owner. They're planning to sell a business in the future. All right, if we can accumulate these losses and that unused loss, like I said, it'll offset $3,000 of your ordinary income, but then the rest carries forward to subsequent years. So that loss just keeps carrying forward, and eventually, hopefully, you'll get to use it. And so if maybe you're a business owner looking to sell your business, all right, we could be tax loss harvesting so that when you sell your business, we've offset a lot of that capital gain from selling your business.
And let's say they've realized more losses than they have gains, more losses than the $3,000 of income. They can carry those losses forward.
That's right. Yep. And until you use them, indefinitely.
Okay.
Although when you pass away, they don't go to your spouse.
Oh, okay. There is a timeout on the clock.
Yep. If it's an individual account, that's your life. Yep.
So, and I really feel like the benefit, like you're saying, though, is to offset the gains, because by offsetting the gains with those basically manufactured losses, it's more of like a present value thing than a future value thing, right?
Right.
It's the present value of the taxes that you would otherwise pay. So now you save those tax dollars. What are you doing with those tax dollars you save? Because ultimately, if you sold to manufacture that loss, bought something pretty similar usually is what we do, kind of equivalent. It's not going to be something totally different. So it's probably going to recover in a very similar way, hopefully better than what we sold. So that gain's ultimately going to be there, and you've now reset the basis lower. That capital gain's going to come back to you. But does it come back to you in a future where you've either offset that gain with a loss or when you're at a lower tax bracket, right?
So, I mean, you would tax loss harvest, and then, at some point you want to use that loss. So maybe if it's not like selling your business or something like that, it's just a time comes where you need to rebalance your portfolio. All right, now we're able to do it. We're able to sell equities to buy more fixed income.
I like that you've added that, because usually the stock market's going to outperform the bond market, right?
That's right.
And unless you're 100% aggressive and 100% stocks, if you're less than that, most of our clients are moderately aggressive. Retirees are usually moderate. They've got to pull back these stocks that take off to rebalance the portfolio so that next bear market doesn't hurt as much, right? And that's going to realize gains just to keep that risk level in control. But if you carried forward some losses, it's a lot easier on the psyche and on the wallet.
So just a quick example, like 2022, the stock market was down, the bond market was down, and we tax loss harvested a lot of accounts. Well, we've had 2 really, really good years, and everybody's equities are substantially higher there. And so we have to have these conversations about rebalancing back to their targeted risk level, because the equity portion of their accounts have grown way above the targets. But it's a lot easier to talk to somebody that has this loss carry forward saying, hey, we can rebalance your account. and it's not going to cost you anything versus somebody who doesn't have that loss carry forward. And we're like, all right, we can rebalance your account, but it's, you're going to owe some tax, which is still, we got to manage risk, and we don't want to let, taxes too heavily influence a prudent, risk management process.
Right. Right. And that just kind of helps them make that decision. So again, the tax loss harvesting is really just going to be happening in a non-qualified account.
Yep.
So these are usually just strategies that we reserve for folks that have large non-retirement taxable accounts, where we're trying to, kind of minimize their taxes over their lifetime and make these rebalances in the future a little bit easier to swallow. Yeah.
And we don't want to do this for everybody because, like we said in our first episode, some folks can realize gains at a 0% tax rate.
Right.
And so that's, and actually we're going to get to this more in just a moment, but,
we'll go ahead and walk into it. Yeah. When you can realize that 0% cap gain.
In this year, 2025, a couple filing joint can realize almost $97,000 of capital gains. If their total taxable income is $97,000 or less, any of the capital gains that make up that taxable income are taxed at zero.
So basically, if you add income plus capital gains realized, if it's 97,000 or less, you're dealing whatever that capital gain realization was is going to be
0%.
So right. Cool. So again, that's why it's important to do the planning, because everybody's plan is pretty unique, and customized planning is important. That's why we do it around here, because the reality is we might go, hey, the market's down, but we don't want to harvest a loss for you right now because you could realize gains for free. So we don't want to offset those gains.
Right.
Okay. Yep. Very cool. Very cool. So, and there's, go ahead.
Yeah, we kind of covered number 7.
That was number 7. Yeah. Be sure to pay attention to those capital gains when you can realize them at 0%. So let's skip on here to one of the tax planning pro tips here is to manage the healthcare costs and taxes. And so I'll speak to this a little bit and then let you add, Justin. So you've been saying on our episodes, one of the things that we really love and take pride in is getting our clients to retire early, at least earlier than they thought.
Yes.
Right. And now if you retire at the 65 and you move right into Medicare, move right into Medicare. But often our clients are retiring before that. Right.
That's right.
And that big obstacle is usually like, well, I have enough money, but what do I do about health insurance if I quit my job?
There's a lot of anxiety, right? Just on that topic alone.
So, absolutely. So, but there are a lot of options for folks once they leave their place of employment to self-insure or go on the marketplace or go on the Obamacare options there before Medicare kicks in. So during that gap, where does taxes impact the cost to handling healthcare on our own if we retire early?
So Obamacare, the way it's structured right now, is a big opportunity for a lot of folks that retire early. And it's income-based, not asset-based. So you could be a multimillionaire and still qualify for Obamacare.
Subsidies.
Yep.
Yeah.
And so it's, there's a lot of strategy. What we in the episode 1 talked about the 3 different tax types: tax deferred, taxable, and tax-free. And so in these early retirement years, if healthcare is one of the problems we're trying to solve, well, we need to look at Obamacare. We need to look at, can we pull from your taxable account? Can we pull from your tax-free account? Maybe you had in addition to your Roth, had an HSA that we can use some as well. And that's a tax-free distribution there. So can we construct your tax bracket? And it's based on your modified adjusted gross income. Well, meanwhile, providing you with the income you need. So let's say you need $120,000 a year. Well, can we keep your income, your modified adjusted gross income down to about 60 while still giving you $120,000 a year? And then you could get a substantial subsidy. It's probably not, it's actually maybe cheaper than what you're paying while you're working.
Yeah. If they're pulling something out of your paycheck for that. So definitely what we want you to hear is that don't let that stop you from retiring early.
That's right.
If you've got the ability to replace your income and recover, or at least the living expenses that you have in retirement are going to be covered, don't let not having health insurance stop you, because there are some really great options. And if you meet with an advisor, like you said, you have different tax types, you can be strategic about it. you could be potentially having great healthcare coverage for very reasonable, if not even less than you were paying before.
Yep.
So that's a big deal.
Subsidy can be huge.
Right. And we have clients that do this. We have multi-million, they're worth multiple millions of dollars in terms of net worth, but we've got their taxable income low enough that they're getting major subsidies on Obamacare until they're 65.
That's right.
Yeah. Big deal. Big deal. Very cool. All right. So tip number 9, optimize your portfolio with tax efficient investments. So tax efficient investments, is this something I need to put in my IRA?
Your
that's
IRA,
not really going to help me.
That's not what we're talking about here.
Mm-hmm.
Yep. So, your IRA and your Roth, you can trade in there. You can have dividends and interest, and you don't pay tax on the capital gains or the dividends or interest. But in your brokerage account, if you sell something for a gain and you don't have a loss to offset it, you're going to pay tax on the gain. And then any interest or dividends, you're going to be paying tax on that as well. So we look at how can we build a more tax efficient portfolio in those taxable accounts. One of the things that we like to do is use ETFs over mutual funds.
Why is that, Justin?
So mutual funds have what's called a capital gains distribution, or they can have that. And so whether you participated in or an investor in the fund all year, or maybe you bought in November, and then the fund was basically gone up maybe 1% since you bought it, but maybe the fund was up 20% for the year, and that fund manager sold some of the stocks that are inside of that mutual fund. Guess what? You get to pay the capital gains tax on those stocks, even though you didn't get to enjoy that big gain in the mutual fund. You got to pay the tax on it. Yes, it does raise your basis. So you get, it kind of evens out in the long run, but it's still a taxable event that year for you, just because the mutual fund manager decided to sell some of the stocks in the portfolio. So ETFs, you don't have these capital gains distributions, or if I shouldn't say never, but it's very rare and uncharacteristic for an ETF to have a capital gains distribution. So taxable accounts, we like ETFs. And then on the fixed income side, we like municipal bonds. So the interest earned from those municipal bonds or municipal bond funds is tax exempt on the federal side. So you don't, you still pay state income tax on that interest, but you don't pay federal income tax.
So it sounds like there's 3 main components, at least, that we utilize when managing our clients' taxable accounts. It would be tax loss harvesting, using ETFs over mutual funds, and using municipal bonds over maybe corporate taxable ones.
That's right. And then the other is just the way we would trade the accounts. So we're much more tax aware when we go in to rebalance a portfolio, is making this adjustment and realizing these cap gains. Is that worth the tax impact? So we're not going to go and just realize a ton of gains in somebody's portfolio without taking all the considerations into account and without having that conversation. And actually, one of my new clients, I was looking at the December 31st statement from their old advisor, and they had realized like $60,000 of cap gains in his brokerage account, and he had no idea. And so I was the first person to tell him about it.
Oh my.
Oh yeah.
Don't always love to be that messenger of bad news. Yeah.
But he's like, well, this is just another reason why we're exchanging.
Communication is how you have good relationships, folks, not just personal relationships, but with your professionals as well. So we try to talk to our clients about those. And that's a good point, because we're always trying to optimize the portfolio and the models that we have for our clients. And so if it's an IRA and we feel like the portfolio, it needs to improve, we just make the trade because there's not a tax impact. But when it's the larger taxable accounts, we tend to have more conversations with clients around those. That's a great point.
Have to see if it's worth the taxes. And
if the juice is worth the squeeze, some people might say, which is, Justin's trying. I say that all the time. All right. So final one, number 10, we're just so proud of you. If you have listened to both episodes and you've gotten this far to the 10th tax tip, it is to work with a trusted advisor and CPA. So let's talk. I mean, obviously we can talk about, it's great to have a financial advisor, but talk about maybe this 3-part partnership where you have the client, You had the CFP, that's us, Certified Financial Planner, and you had CPA, right? Certified Public Accountant. Why is that like trifecta so powerful?
Oh, it's great to have a team. So, we do try to work closely with our clients' CPAs, and, anything from like getting documents together for tax prep's great, but also like, if you need to make estimated tax payments or we need to rebalance a portfolio and you do need to realize some cap gains, all right, let's calculate what those estimated tax payments should be. Or do you need to make them in the first place? So that's where we can communicate with somebody's CPA and just make that process just work so much more smoothly for our client. And then I'd say if you don't have a team, like you're really missing out on opportunities. Folks come to us all the time with, here's their current situation, but they just didn't know what they didn't know. And so they weren't optimizing things like, for example, pulling more heavily out of their own IRA when they've got an inherited IRA that's got to be withdrawn within 10 years. And it's like, gosh,
it's a big deal.
There's so much value in working with a financial planner that can kind of guide you through these little nuances that most people just don't know.
Well, and we've talked about this for years about, gosh, all of our clients are filing tax returns. A lot of them are using CPAs. Should we just have a CPA in-house, a Goodwin Investment Advisory? And a lot of times we circle back and said, no, because then we would kind of having to force our clients to use our in-house CPA where normally they're already using a CPA. And we've kind of designed like our MO, our service, our business model is to work with the CPA the client already has. Now, if they want a recommendation on a new CPA, we've done our some work to vet some local partners that we're used to partnering with. And so we can recommend them. So we have recommended partners. We can work with the CPA our clients have. When I was serving clients directly, even when we would realize one of these big net capital gains, say based on a rebalanced, or maybe they brought in a security from a different firm and it was concentrated, we needed to reduce that concentration risk. I would actually email the client and their CPA and say, hey, such and such client realized this many gains, and make sure the CPA was aware of that in case they need to make a quarterly estimated payment, right? Because you can be penalized for that. So, and sometimes clients are asking us questions. They don't have a CPA, or maybe they do. Often we will check with our CPAs as well that we partner with, just to kind of have that CPA stamp of approval.
That's a nice thing. We do have a CPA firm that's if I've got a question that's I don't know the answer to, like I've got a CPA that I can reach out to. That's really nice. Yep.
And we have such a beautiful office space here that we will often host the client and their CPA will come in. We've done that a couple of times here, even recently, where the CPAs come in to meet with us and the client. We're all making decisions together. Even the estate attorney, we'll bring in an estate attorney as well if we need to make those decisions. So just know that we are here to kind of be that second pair of eyes, that second opinion, even if it's on stuff that we're not paid to do, like your tax return or putting your estate documents together, but that we can plan and that we can strategize around that stuff.
It's almost like the quarterback.
It is. We're the quarterback. Absolutely. Absolutely. So awesome. Well, thanks again, Justin. And just want to remind the listeners, this is, if I haven't shown the audience on this episode, so this is the right here, 10 pro tax planning tips for easy retirees. So easy to say. But if you want this, you can find our blog that's got the same name on our website. You can just go to goodwininvestment.com, click on tax planning, and you'll be able to click on that blog and get this, the pro tips for free. You don't even have to give us your information. You can just download that. It's pretty cool. If you want to continue to learn more, you can keep listening to the podcast. We also send a really great blog a few times a month. So you can subscribe to that blog. And if you're ready to start learning more about our services, then you can schedule an intro call to learn more. Before we sign off, we love to sign off with gratitude. Justin, I'll let you go first. What are you grateful for?
That new computer.
That new computer. All right. That hopefully won't crash as easy as taking one bite out of it. I will just say that I am really grateful for, we were talking about your kids earlier. My kids, just like the resilience that they have, to adjust things, to learn. I'm really impressed with that. And I just think they're super fun and interesting. I love being around them. So grateful for my kids. So thank you guys so much again for listening or for watching, and we'll see you next time. Bye-bye.
Thank you for tuning in to the Money Pig Podcast. We hope you enjoyed today's episode. To stay updated on new episodes, be sure to subscribe wherever you listen to podcasts. If you found value in today's discussion, we'd greatly appreciate it if you could leave a rating and review. If you have any questions about the topics we covered, feel free to visit us at goodwininvestment.com and reach out. This episode is produced by evance.net. This podcast is provided for informational purposes only and should not be considered as investment advice, a solicitation to buy or sell any financial products, securities, digital assets, or other investment vehicles, nor as a basis for making any financial decisions. Goodwin Investment Advisory is a registered investment advisor with the SEC, CRD number 131193. Please note that the host and or guests may personally own securities, digital assets, or other investments mentioned in this podcast. Investments carry risk and are not guaranteed unless stated otherwise. We strongly recommend consulting with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategies discussed in this episode. Lastly, past performance is not indicative of future results.